It is Fed Day. We are likely to get a 0.75% or a 0.5% rate increase. For you and your clients, does that extra 0.25% matter that much? I mean, if we get 75 basis points, you sell everything, go get the shotgun and run out to the barn? I mean, how do things look based on the different outcomes?
Right. You're absolutely right, Brian. 50 or 75 does not really make a difference at this point in time. I think what we're really concentrating on is how far and how fast that inflation number is going to fall in 2023 and how committed the Fed is to that 2% target. And wages really play a big part in this, and the strength of labor market in 2023, together with potential China reopening, and also, volatility that you just mentioned around energy earlier on in the segment. So I think all of those things put together means that it's not going to be a straight line for inflation, which means that today's number, or whatever the Fed wants to announce, 50 basis points, 75, really doesn't really make that much of a difference right now. Investors should be positioning for 2023.
Yeah, that's it. I mean, I don't want to throw water on our Fed coverage, of course. The Fed does matter. Their outlook probably matters more. What they actually do may mean a little bit less. All right, so we're focused, as you said, Linda, on 2023. Hard to believe it's already here, my gosh. That said, what are we focused on? What are the key things that we need to be watching?
Sure. At Federated Hermes, we do expect that earnings are going to fall to around $200 level for the S&P 500. They're about $230 right now. So come January, February, fourth quarter earnings and 2023 guidance, we do expect earnings to start to fall, really to get driven by margins coming down. Energy and tech are probably not going to be big contributors to that earnings number. In addition, volatility is again going to be the name of the game in 2023. The pace of economic growth, inflation, Fed, China, earnings, geopolitical issues are all going to create volatility. And what we're really facing is a slowdown in the economy. We just don't know how fast and if it's going to be a soft landing or a rocky landing.
Yeah.
And hence, I think having a portfolio that has some cash to take advantage of opportunities that they arise, probably in the first half of next year, and also tilt more towards value dividend sectors of the economy. We'd like pharmaceuticals, for example. We do think that pharma and healthcare is an all-weather type portfolio. And you've been covering energy extensively. Energy prices are probably going to, move higher if we have a soft landing. China reopens. It's going to put pressure on energy prices again. Yeah. And we like materials on the back of that as well.